would want to start the business with. 5 million, 10 million, 200,000, 300,000, 20 million. So it depends. And also how much you are receiving from your workplace. So you'll be saving from there. And it means you have a target. So, okay, I want to start the business, but I'll start in 2019. The whole of this year, I will be saving, if you want.
Is it possible to save?
Yes, it is possible. How it is possible if you got a bank account?
Maybe
sometimes you can even write the bank to say this amount, standing order every month is my salary when it gets in, knock this amount into this account. You open that one separately, or you open a fixed deposit account, for example. So you put the money there. There will also be some interest, so that you arrive at your target faster. So you open a fixed deposit account. You tell the bank every month this amount from my salary should be going to this account. Over time, it's also getting some interest.
So maybe you have like issues, and you say,
it's your money.
Let me go back.
It's your money. It's your money. For instance, you've been saving. You are looking for 2 million, for example. You have saved 500,000. Surely you are in financial deficit somewhere. You are looking for 100,000. Can you not go to your account and get it from that 500,000 in the bank which you were saving? Can you? Why not go? You go and get it, because you haven't started the business. You can go and use it, and then you proceed. Adding the figures on that amount. So I don't see any problem. It's your money. It's your money, but it will just give you a financial discipline that you should arrive at your target faster. So when I said if for 1 year saving, it all depends on how much. Maybe you're looking for 20 million, 50 million, 30 million business, big one. And you cannot raise it in 2 or 3 months. So you're saying, okay, let me give it 1 year. And then let me raise this money. Next year, I'll start the business. And when it starts, it means you have prepared everything in 1 year, all those things. Other than 30 million business, 20 million business, and then you only have 2 million. And then you say, I have got this cash, I'm starting. 3 or 4 months on the line, you can't pay salaries, you can't pay rentals, you can't pay creditors, then everybody will be on your neck. Why? You did not do good preparation. So all these are examples, but it depends on how much is the capital, when do you want to start the business, how much revenue do you receive from how much salary do you receive from your employer. So if all is well, taking things equal, we are saying you can plan. And then savings is one of them. And remember, I'm saying savings is the perfect substitute of borrowing. If you don't want to study by borrowing, the perfect substitute is savings. So save. So number 1 is savings. Number 2 is what I would call sale of fixed assets. So when you are selling fixed assets, assuming you have surplus assets, like vehicles, maybe you've got 2 cars, you can say, let me sell 1 car at 30 million. Your capital is 2 million, and yet you are selling 1 car at 30 million. So then you're okay. You take the 3 million into the business, and you have 1 car, which you can be actually doing some operations. If you have those 2. You can be able to do that. Or maybe sometimes you have a land and you don't have money that you can build the house, or whatever you want to build on that land. You can say, let me sell this land. So you sell that land, good money, and then you can take that money to business. In fact, my principle as a business coach, I like financing my operations. I like financing my luxuries from assets. If I want things, let me have assets which should finance my cash flow. All we should be talking about is cash flow. And if you're saying you don't have money, it means you don't have, your cash flow is very bad. If your cash flow is very bad, it means no money is, your pipes, although your pipes in terms of your accounts are very dry. So if they are very dry, you have a very big problem. So you need to improve your cash flow. How the cash should be coming in. The cash inflow must be able to improve. So how do you improve? By having the assets. So if you have got the assets, 1 or 2 there, those assets will be making money. And then from assets, you can be able to say, let me buy a car, let me buy a house. From the assets. Assets could be businesses, for example. Yeah, so let's have assets. Assets will bring us good cash flow. So it's very, very important to understand that. So
welcome to the Business Coach. This is a very good time, a very wonderful moment whereby we do talk about issues to do with business. If you want to venture into any business, this is your beautiful program that you should be watching in order for you to enhance your skills. We have the business coach in today's edition of the business coach, Professor Kingston Prince Ngwira. My name is Precious Chikatiko. Stay tuned. Welcome, the business coach.
Yes, welcome indeed, Precious, into another program of Business Coach. And let me also welcome all the viewers there watching us at Pentecost Live Television, KPL TV. But it's specifically the aspiring entrepreneurs, those that want to venture into businesses, but also those that are already in businesses. They want their businesses to do well, to boom and go to another level. We are saying this is the program which is aired every Friday here at PLTV, but also Mondays and Fridays on PFM. So we ask you to stay tuned so that you can again get one or two lessons, get one or two competencies, skills, and knowledge, and then when you apply to your businesses, you find that possibly you are actually moving to some levels.
In the last edition, we started talking
Yes.
about business financing, and I believe today we are going to proceed from where we
Yes,
stopped.
yes.
But maybe before we come to today's discussion, we should be able to remind our viewers where we are coming from
Yes.
as regards to business financing. So maybe if you can take us through the last
Yes,
program
yes.
in summary.
Yeah. In summary, we did, Precious, we looked at business finance. In short, how do we finance the business? Or how can an entrepreneur raise funds for his business? But also maybe they might be in different categories of businesses. Others might choose to go alone, to go solo, all right, as an individual. So they become owner managers, and then we call them sole traders. Or maybe one decides to go into business with someone, which is called partnership business. Or indeed, sometimes they even go to a limited liability company, but they are individuals. So you have these levels or maybe types of businesses, the sole trader, partnership, and also the limited liability company businesses. So the type of finances to these might differ. Depending whether it's sole trader or partnership or possibly the limited liability company. Because limited liability companies sometimes talk about shares. And in a sole trader, you don't talk about shares. Basically, it's the capital contribution. So in this program, we'll start looking at the individual who is an entrepreneur. Either he's already in business or he wants to start a business. How can he raise the finances? And number one, the issue of finance maybe comes number two. The first issue we talked in the preparation of how you prepare, getting ready, getting started to go into business. I said one of the issues is to ensure that one has a vision. A vision is ultimate because in Proverbs 28 verse 19, the Bible says, without a vision, the people perish. All right? So without the vision, businesses can perish. So vision is very, very important. And today you see many companies, they are putting the vision statements, mission statements for their businesses. They put it on the wall and people will be able to read. Unfortunately, not many entrepreneurs or not many employees by entrepreneurs who are in those businesses would actually remember the vision statement. It's just on the wall. Or maybe one has just crafted it because he wants to go into business and then he's somewhere, but he's not living to that. So we must live by our visions. The vision helps us to move forward. It energizes us. It propels us. Because, as I said, it answers three questions. Where are we? Where are we in terms of finances? Do we have the finances? We don't have. How do we get the financial deficit? Where are we in terms of maybe employment, in terms of staffing? All right? Do we have enough staff, or we are understaffed, or we have surplus skills which we need to retrench so that we don't have to hurt the profit and loss in terms of our profits by having a bigger wage bill, and then we have huge expenses because of the salaries or wages. So you're looking at all those things. So the vision is very, very important, and it must answer those questions. Where are we? Where do we want to be? And how do we get there? How do we get there? Those are now the ways, the strategies on how you can reach to your destinations, where you want to be. It could be in the area of revenue. Where are we? We are making 1 million per month. Where do we want to be? We want to be at 10 million per month. Then how do we get there? So we find, okay, we need to employ people. We need to have some resources like maybe assets, maybe vehicles to help us on deliveries to customers in terms of goods, corporate image there, okay, and other issues of sources of finance. How do we finance this? All that is how do we get there. So that when we know where we are and where we are going, then it will not be moved. And we know we could be small today, but tomorrow will be big. Because in entrepreneurship, everything that is big begins small. And we say that an army grows by adding one soldier at a time. So we don't have entrepreneurs, we don't have to think of having a bigger or conglomerate, just in one day. We will enter into problems, we will enter into troubles. But little by little, gradually, you add one soldier at a time, you'll find that you are growing in your assets, you are growing revenue, you are growing your profits, and the company is growing, and then you should be able to add other SBUs, other businesses from the first one, and you can manage now from one business to many businesses. So when we have the vision, then we can think of issues of business finance. Yeah. Now, last time, I think we used the term capital structure to understand the issues of business finance, capital structure. So the capital structure, we said simply it means how a business is financed. Is it financed by equity or debt? Right? And we define to say when we talk of equity, we are talking our own funds without borrowing. Those are equity funds. Or you have borrowed somewhere, either from the bank, like financial institutions, for example, although we say that the funds that you borrow are not free because there is a cost attached to it. That's why that capital that we use to finance the business from the banks or lenders of finance or financial institutions or financial markets, we call it cost of borrowing or cost of capital. So it's cost of capital or cost of borrowing, looking at issues of interest because that money is not free. So either you borrow, that's debt, or you have your own monies, that's equity. So it means in the capital structure, how the business is financed. We are saying it's financed either by equity finance or equity capital or debt finance or debt capital. So these are the two issues that we talked in detail last time, but here I'm just trying to summarize the issue of the capital structure. So today we'll also focus on what we call financial management in regardless of in relation to the business finance. But we'll also look at what are the ways that one can go in business finance and between equity finance, your own funds, financing into the business and the debt capital. Today, because of time, we cannot discuss all. We'll only look at one area, the equity finance, your own funds without borrowing. How do you source those funds? How do you get the funds? And then you can get started. Remember we said in this program, preparation is very, very important. And the time of looking for finances, sources of finances for your business should be part of preparation. And it's not, we're not trying to say, you say, let us go and we see it there. Then you'll be able to goof. Because if you're starting a business, the first month you need to pay salaries. And indeed, if you don't have your own business, the first month you need to pay rentals. Now we just go there without preparing. Then the first month, second month, you find that certain activities cannot be done because finances are not there. So when you do preparation, you can say, okay, let me give my business 6 months, or let me give my business 1 year, and let's have salaries for 6 months. Let's have rentals for 6 months, operations for 6 months, and then you are preparing it to grow. Because at this level, you're looking at 3 things: managing operations, managing investments, but also managing growth. All right? You start on a small note, on introduction stage, but you'll be focusing a window or an opportunity for the business to grow. Even when we are putting, or you want to invest, or you want to make your business, you put a location of your business, you go with your business to places where you should be able to get more money, where the revenue would be very numerous. That's where you'll be able to put your business. So today we'll look at the area of equity finance, and possibly in another program we'll look at the area of debt finance. How much should you borrow? Because if you borrow too much, you overborrow. We call it gearing. It means if you overgear, you'll be able to hurt, or it will lead you to take over, you know, because the one that has brought in more money, you say, I mean, this business is mine. So we want to avoid all those things. So there is a level or a threshold we should not go over in terms of borrowing. Let's not overborrow. But also we'll discuss in this program that we don't grow the business by over borrowing, saying, okay, our assets are maybe 20 million. Let's just go and borrow 50 million. So that with the 20 we have 70 million. And then we are saying we are growing in the business. We are okay now. We had the 20, we have 70. But between the two, who is now the real owner now? It means it's the 71. What if he kicks you out, say, get your 20, and then we go using, legal suits. Get your 20, you're not failing to pay, and then our 50 million will remain in the business. So what do? So you might lose actually the business. So there is need to look at those. So we'll look at that under the area of debt finance in those areas. Debt equity ratios, all those areas, we'll be looking at that.
Remember, you're watching The Business Coach right here on PLTV. We are talking about financing a business, and The Business Coach has ably said you can finance a business by equity financing, that is your own funds, as well as debt financing, that is borrowing or gearing. So today we are going to talk about equity financing.
Yes.
In detail.
Exactly.
How would one find money to invest in a business?
Yeah. Basically, I think we'll talk about five ways that are key. But before that, let me push in or elaborate how these things work. We have a simple accounting equation so that anybody should be able to understand. A simple accounting equation which is called assets is equal to capital plus liabilities. Assets is equal to capital plus liabilities. When we talk of assets, we are talking of both fixed assets and current assets. Fixed, in short, assets are possessions. The possessions, the things that you have, okay? And you have fixed assets and you have current assets. Fixed assets, these are possessions that are fixed, like possibly they also have long life, like maybe cars, for example. You have buildings, for example, computers, furniture for the offices. Those are called fixed assets. And then current assets, you have things like debtors. Debtors are customers that buy goods on credit from you. You are selling a product, but you are not demanding immediate payment. There is an agreement, maybe the customer has to pay 30 days, for example, after 30 days. So those are debtors. So they are called current assets because you know you can turn it cash, you can have cash anytime, so it's current. If you go and do debt collection, you pressurize them, they'll be able to give you the money. So it's under current assets. And you have stocks. Stocks, others call them inventory. These are goods in the warehouse or purchases that you have bought with the intention to sell. So you know if you have got stocks, if you sell one product today, you have cash. So that's why it's called the current assets, meaning stocks or inventory. But also you have the real cash. We would call it cash in hand. Others, they would have petty cash, all right, or maybe a good float that is there. So this cash in hand, maybe at the office, is part of the current assets because you have liquid, which you can use. And lastly, you have the cash at the bank. The monies that you have at the bank are under current, it's an asset. So it's under current assets because you have it immediately and you can use. So you have debtors, you have stocks, you have cash, and you have good money at the bank. That's the current assets. So current assets plus the fixed assets, the furnitures, the vehicles, buildings, and other plant, machineries, all those things, the total of that plus the total of current assets, we would call that as total assets. So when we say assets is equal to capital plus liability, we are talking of both fixed and current. So you will see from my presentation, assets from the left side is equal to capital and liabilities on the right side. What we are saying is the financing part does not come from assets. The financing to the business is coming from capital plus liability. And now if the money has come in terms of capital and liabilities, where do they go? They are going into assets. That's why we call it assets is equal to capital plus liabilities. Additionally, when the business is just starting, it doesn't start with the capital plus liabilities. It only starts with the capital, which is equity, which we want to discuss now. Because in many cases, not many would borrow a business that is just starting. Even if you go to the bank, as we're talking about liability is debt. So it's like assets is equal to capital, which is equity, plus liability, that's the debt. So we are saying equity capital plus debt capital, when you get these, they are triggered into your assets. Okay, some money goes to the bank, some are in the stocks you want to sell, and later on you have debtors, and then some with cash in the hand. So it's others you have gone to buy the asset, the fees, the vehicles, the furniture, and whatever. So that money has gone into those assets. But when the business is starting, we are saying it doesn't start with the capital and liabilities. It starts with capital alone. Because if you go to the bank, for example, all right, if you say assets is equal to a liability, it means you don't have your own equity, is your own funds. If it's assets is equal to liability. So because of that, if you go to the bank, they will say, okay, you want us to give us a loan, to give you a loan. Give us this information. You give us maybe financial statements. So you're talking of income statement or profit and loss account. You're talking about balance sheet or statement of financial position or the cash flow statement, these three. So they will say, give us for the last 3 years, for example. Or they want to see on the income statement or profit and loss account. At the top there, you have revenue, you have turnover, and then you have cost of sales, and then you have gross profits, and you take off administrative expenses. And then if it is a limited company, you have maybe profit before tax, and then taxation, then profit after tax, then you have your dividends there. So while in a sole trader or partnership, it ends on where we would have, let's say, turnover or sales minus cost of sales or purchases, we have gross profit, and we take off administrative expenses. Then what you have is net profit. You don't have all those other areas because they're not dividends, all those things. So all the profits belong to the customer, to the sole trader. So they would want to see the banks, your income statement of profit and loss. How much revenue do you make? Because there's revenue or sales or turnover, then your costs. How much revenue do you make over a given period of time? Let's say monthly or 6 months or every year. And then what profits do you make? If we give you a loan, are you going to repay? They will look at your revenue. And even after having it paid, are you having enough to run the business? Because you become partners in business with the bank. So the bank would still want to see your business that is growing so that they get more from you. All right? They get more from you. So looking at that, you will see that the bank will say, we want income statement, we want financial statements, bank statement, balance sheets. That's where they're going to see the assets. In the case, Precious, you are an entrepreneur and you default, which asset can we get? Is it a vehicle? Is it a building? Is it a machine? Are they sellable that they can recover their money quickly? So they would want to find that. Now you find you're starting a business, you don't have even assets. So how do they give you the money? If in case you are default, what are they going to give? No. It's like, loans are favored to those that they already have. So you want to give me money only when I have assets, and you're also saying these must be collaterals, securities or sureties. Chikore. Where am I going to get them? I'm just starting. And the government, for example, has actually pleaded to commercial banks to soften up a little bit to a certain level to say, okay, we'll be giving you this, but without any collateral. But the banks are looking at the risk. And they want to invest where the risk is very low. So as a result, they want somebody to open the account, and they are saying, okay, it should be there for maybe 6 months or 1 year. How is the revenue coming in? And if there is a little revenue, you can say, oh, these people. And they are looking for 20 million. Someone needs to find that they have got that problem. So in short, I'm saying it's difficult to get borrowed funds like from banks if the business is just starting. Even if you have a good business plan, there is a very, very big problem, unless you have got some backing somewhere. But otherwise, there will be a problem. So this means that a business will start with assets is equal to capital. The liability will come later. So it's assets is equal to capital. Later, we have assets is equal to capital plus liability. So that the capital alone, that's the equity funds, what you already have. So if we are looking at how does one go into financing his business with equity funds, where does he get the funds? There can be 5 tangible ways. Number one is raising funds to finance your business if you want to start a business through savings. All right? That's the sure way. Through savings. You could be working like yourself. You want to go into business. And it doesn't mean that when you are working, you cannot do business. Only that there should not be conflict of interest with what you are doing and at the office. And you also think of employing people that should be doing that business on your behalf. And then you just you oversee and you get actual reports. So you can start a business with the savings. So you'll be saving. So the aspect of vision comes in. Remember, vision answers 3 questions. Where are we and where do we want to be? So you say, okay, how much capital do I need for my business to start? Okay, I just need 5 million. Okay, I need 2 million. Or I need 1 million. Or I need 200,000. Whatever you decide. Then that's where you want to be. And the question like, where are we? From the 200,000 you want to start with. How much money do you have? Okay, I've got 50,000. Or I want to start a 2 million.